coming and checking out another video with your man Ray. So today we're going to be talking about ways to survive a bear market, how you can make a little money, the do's and don'ts, and just a few things like that. So first of all, we need to know, what is a bear market? Have you ever heard of the saying, what goes up must come down? Of course you have. You aren't living under a rock, are you? Bear markets are a fact of life. It's hard to time and know just how much it will take the stocks down, but that doesn't mean we can't make a little money during this period. So bear markets are basically a game of dominoes. Once one starts falling, they all start going. Bear markets start when the price of securities drop significantly, usually more than 20%. So those big falls in the stock market or bonds or something like that could all trigger this. This in turn will scare others and creates more fear that the market will continue to downtrend, causing people to sell off to prevent further losses. So like I said, this guy right here is like, oh no, I'm gonna sell, and then Jimmy down the street's gonna be like, oh no, Timmy's selling, I better sell too. And then it just keeps on trickling down and trickling down, and everyone's selling and everyone's being a big old scaredy cat. But Ray, how do we make any money during all this? Well, I hear your question, and let me answer. There's a couple ways to make money during a downtrending market, but most important part is to not sell out. So many people get scared and want to sell, but if you look over time, the market will always continue to go back up. Stocks only go up. Over time, if you had bought in during any period of into the S&P during any period where there was a downtrend, you would still be up higher right now than you were at that time. So never sell. You could buy at the tip top of the market, and as long as you wait long enough, you're going to be there again. The only reasons to sell is if the company's making a fundamental change in their business, or it's getting pretty obvious that they may become bankrupt. So if we look at this chart here, we can see that if you had invested just $10,000 in 1980, by 2012 you would have made $332,000. Holy moly, guys. That is a reason to invest if I've ever seen one. But just look at this, just missing the best 5 days is almost $100,000 loss just because you pulled out during those rough times and you missed the 5 best trading days. If you missed the 10 best trading days, that's about another $50,000 gone. If you missed the best 30 days, oh man, you're really getting tanked there. And the best 50 days, all the way down to 30,000. You're only 3 times your money instead of 300 times your money. Another thing you want to keep an eye on is trying to time the market. Timing the market never works consistently because it's hard to know the bottom. If you wait too long and buy the dip, you could miss your chance to make some profits on the rebound. Alternatively, if you are too quick, you risk grabbing the falling knife and bleeding with the market. Another thing you want to try to avoid is buying into the market all at once. I know it's very, very tempting when I see those red days just to YOLO all the money in and buy some more stocks for when it becomes green again. But most of the time that'll hurt you. It's better to buy in and take a percentage of how much you want to buy in, and buy in so much this day, so much this day, so much this day, and just keep on going, because then you have your average price will be better, and if it goes up, yeah, you might not make as much, but if it goes down, you won't lose as much. So definitely don't try to time the market. Timing the market never works consistently because it's hard to know the bottom. If you wait too long to buy the dip, you could miss your chance to make some profits on the rebound. Alternatively, if you are too quick, you risk grabbing the falling knife and bleeding with the market as it continues to go down. In a correction, you often hear others say, hold and buy more. But if the market was to drop just 10% and you bought all in, then we get another 20% dip, and you're left in the red with no money to buy at these newly discounted prices. I mean, it could take a while for you to go back up. The best practice for buying any stock is to break it up from one large position, like I just said. For example, let's say XYZ Corp is trading at $25 a share. And you believe this company has a huge potential with TAM and that they will be a large part of the future. So you buy, 4 shares for $100, $25 a share. Now let's say something happens in the market. XYZ Corp drops to $20. $20 a share. You're like, oh, this is a steal. I'm going to take this rest of my money and go buy more. So you buy another $100 worth. Okay, well, that's nice. You got 9 shares now at around $22.50 for the average price. It's not too bad, especially if you get that pump back up. So now your holdings are at $200, right? You bought the first one for $100, 4 shares, $25 each for $100. It went down to $20 a share, so you lost $20. Then you bought in with another $100, so technically you would have about $180 in your holdings, right? You would have spent $200 and you'd only have $180. Okay, so let's say more negative sentiment happens. It's just this bear trending market, everything's going to poop. And now it's down to $17.50. So if you had bought in all at once, you would only been able to afford 8 shares instead of the 9 shares. And your unrealized net loss, because remember, it's not realized till you sell. You're never a loser or a winner until you sell. But your unrealized net loss would be $60 with a portfolio balance of only $140 at that time. Alternatively, if you have done things how I described and you bought in as it progressed on, you'd have only lost $42.50 and had an ending balance of $157 consisting of 9 shares. So, that's not a huge difference, but when it comes to having a couple $1,000 in your account or even $1,000 in your account, that little extra money is a big difference. That's a whole nother share of Zynga with just 9 shares, just $200. So now we're going to talk about how do we make some money in this bear market. Now there's a few ways to make money. I don't really like the main ways that they say to make money in this. I'll go over that later on, but let's just get into it. So the first way you can make money is find what's increasing in value or holding its own. So during this time, there's going to be lots of times where these companies are going to be oversold and basically undervalued. So you'll be able to get some really, really good deals in the market. You just got to keep searching and find these. Periods of downturn, certain assets continue to improve. During COVID, online retailers and delivery services were the place to put your money. So, figure out what's causing the downturn and figuring out what will do well during the downturn. I used to work in a casino, and I was told that during downturns, casinos tend to do well. And sure enough, I bought in at $75 at Win. It's up to $130 at the time of recording this. I bought in at $22 a share with MGM, and it's at $34 or $36 right now. And I'm pretty sure that if you had bought in at the very bottom and gotten buoyed, you'd have 3x your money. So, sometimes it's a trial and error. Sometimes you just got to know from the crash before. And sometimes, most of the times, you just got to get your butt out there and start doing the research, man. Due diligence, due diligence, due diligence. So usually things like consumer goods and precious metals and other materials that are not connected to the current events will do well. You can go online and search up sector performances and see how each sector is performing and allocate your funds as necessary. Now here it gets to the point where I don't really even want to bring this up because it could end up hurting a lot of people. So we're going to talk about short squeezes. So we're going to talk about puts and shorts. And if you see about what just happened with the recent short squeezes with GameStop and a few other ones, you can see just how bad this really could be. You could be left with no money or owing a buttload of money. And, you know, any options contract, basically you could, but, and maybe it's just because I like calls more than puts, but, you know, I'm not a big fan of puts. I have bought in some puts. I made a little bit of money on some puts, but I don't really like them. But we'll talk about them anyways. So basically an option is a contract that gives you the ability to buy or sell 100 shares of any one specified company before a fixed period of time. So basically with a call, you're calling you up the elevator. So you want the price to go up, 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 and you make more money on that. If your strike price, there's a strike price, which is a price which you think it'll get to before the end, and if it's above that price, you're in the money with a call. If it's below that price, your call expires worthless, and that's not really a good thing. That's where you can potentially lose a lot of money. Now with a put, it pretty much works the same way. The put is selling, you're putting somebody down, so you want the stock to be less than what it was. Now, a good time to do this is when a stock has a major run up, like some of these short squeezes. A lot of people have made a lot of money on the puts on the way down. Now, when to buy these puts and what the price will go back down to after we're left with the bag holders and everything else, that's where it gets a little risky, and I have not enough experience with puts to really give you a good idea on that. So because you're controlling 100 shares, the gains and losses are magnified. Small moves in the stock price can result in large swings of your options contracts, which makes them so attractive. Generally, if you can make more money on less money, and that's the reason why people do it. Yes, there is a bigger risk-reward profile, but, you know, you got to take the risk to make the money sometimes. Another way to use puts is to sell naked puts. This is basically selling the right to stocks you own. So if you have 100 shares of any one company, you can probably, unless they're small cap, you could probably sell some puts on there. If the put does not reach the specified amount, the contract will expire worthless and you'll profit from the premium paid. So again, I don't have very much experience in this, but ideally, you're going to say, all right, I got this 100 shares of Apple. Apple's trading at 125. I don't think Apple will get to 140 by the end of the week, so I'm going to sell a naked put option. So I'm going to give somebody the option to buy all my shares from me at 125 if the stock price goes to 140 by the end of the week. Yeah, you may lose about a little bit of money that you would have made there, but it probably won't happen, and you'll be able to reap the premium paid for the contract. And that's how a lot of people who are going to just hold, and they don't care about anything else, they're holding the company for long periods of time, selling puts on there because they know the company is just going to continue to go up, and they think it's a good idea. Actually, I think I had that backwards. I think it was a put and a call. I think I just explained a call to you. But it's basically the same thing, but backwards. He wants the price to go down instead of up. So at the end of the day, a bear market is nothing to be worried about, and oftentimes it can be a great thing because you can get a lot of cheap stocks. You get a lot of great deals, and if you hold until the next bull market, I mean, you're just going to make a bunch of money, man. If we look here, speaking of bear markets, historical performance of the S&P during a bear market, you know, there are these little tiny blips, and then we got these huge run-ups. So even if you bought the very top of the peak of last year's or last bull market, and you make it through the bear market with all those shares intact, strap on your rocket ship, boy, you're going to the moon. All right, so I want to thank all you guys for sticking around to watch another video of mine. I'm sorry it took me so long to record this one. Spin issues. We'll just leave it at that. But I'm going to try to get more consistent. I'm really going to try to put out at least one video a week for you guys. I thank you all for just the like, the shares, the comments you got. I know I'm a small page, so it really means a lot to me. And if you haven't already liked it, go ahead and drop a like below. Subscribe to me. I don't know if I have a bell icon, but you might as well hit that too. let me know what you guys think. Do you guys like puts? Do you guys like calls? Do you guys think we're going into a bear market? Or do you think this bull market's just going to keep on trucking? Let me know what you think. And if you guys want to follow me on Instagram, it's ray.galding, just like my name here. If you guys want to follow me on Facebook, same name, Ray Galding. If you guys want to follow my business or my gaming page, it's Ray Was Her, RAYWUZHUR Gaming, and that one's on Facebook and on YouTube. I'll drop links in the description below, and maybe even like some links up here somewhere. I'm sure one of these points will be to the right spot.